Is Pfizer an undervalued stock to buy right now? I'm going to answer that question by conducting a discounted cash flow valuation of Pfizer stock. I'll use several inputs to make that estimate, but I'll share with you precisely where I'm getting all the numbers from so you can see for yourself the numbers I'm using, the numbers I'm putting into the model. So you can see is it too high, too low, or if it's on point. So let's take a look at this interesting healthcare company. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. All right. Three of the inputs I'm going to need are the company's market cap, which stands at 150 billion, the cash and equivalents balance at 1.1 billion, and total long-term debt, which stands at 66.6 billion. I also need the company's total number of shares outstanding, or the average number of shares outstanding, which stands at 5.7 billion. I'm also going to utilize the Wall Street analyst estimates for its free cash flow expectations over the next several years. And according to Wall Street analysts, they forecast it will deliver 10.86 billion in free cash flow in 2024, 17.6 billion in 2025, 16.5 billion in 26, 18.02 billion in 27, and 17.27 billion in 2028. Of course, nobody knows for sure what's going to happen in the future, but these are the analysts on Wall Street that have been following Pfizer stock, and they have a pretty good idea about what the company's free cash flow estimates will be over the next several years, since they maintain close communication with the management team of the company, which communicates with the analyst what they forecast in free cash flow over the next several years or over the next quarters, and how to think about the company's valuation looking ahead. I also need the beta for Pfizer stock, and the beta is 0.62. Beta measures the riskiness of a company's stock compared to the S&P 500 index. If the beta is lower than 1, it means that it's less risky than the average stock in the S&P 500 index. If it's greater than 1, it means it's more risky than the average stock in the S&P 500 index. So a beta of 0.62 means that Pfizer stock is significantly less risky than the average stock in the index. Also, with healthcare stocks, you get an added benefit that they're typically not correlated with the economy. Meaning, if the economy performs well or if the economy performs poorly, is not going to have any impact or as much of an impact on Pfizer stock. And that's true for several healthcare companies, right? Because if you're sick and you need something, you're not going to look at whether or not your income is increasing or your income is decreasing. You're going to get the help that you need if you can pay for it or if your insurance covers it. So, for that reason, healthcare companies are less correlated to the macro economy, to what's going on in the economy. It's sort of like the opposite of like a car company. A car company is very connected to the economy, because if you're getting hired and you're getting a new job and you don't have a car yet, or your car is too old to be reliable, you'll go out and you'll buy a new car. But if you're getting fired or you expect to get fired soon and you're thinking about whether or not you should buy a car, you're probably not going to buy a car. So the performance of the economy, job growth, income growth has a lot to do with how a car company performs. It has very little to do with how a healthcare company performs, which is a bonus, because most of the stocks that you probably have in your portfolio are very correlated to macroeconomic performance. So it helps to have some businesses in your portfolio that are not correlated to the economy. Therefore, if the economy goes into a recession, your healthcare stocks can perform relatively well compared to the other stocks in your portfolio. Now, they may still go down as well, but the reasons for the declines of healthcare stocks are less connected to the macroeconomic performance and more associated with the company specific performance metrics. All right, so now that we have the numbers we need, the inputs we need, we can jump into the Pfizer discounted cash flow valuation model. Free cash flow, as I highlighted earlier, was expected to come in at 10.86 billion for 2024 and grow all the way to 17.27 billion in 2028. These are the forecasts from Wall Street analyst estimates following Pfizer stock. Now, from 2029 to 2034, I've incorporated my own personal estimate for growth in free cash flow. Let me share that with you. So, in these next few years between 2024 and 2028, the growth rate forecasted from Wall Street suggests that the company's going to grow its cash flows by around 29% over these next 4 or 5 years. So, from 2029 onwards to 2034, I'm forecasting that the company will grow its free cash flow at half the rate that it's going to grow over these next few years. So, it's going to slow down. And then from 2035 onward, I'm going to have the growth rate forecasted to really slow down to the longer term trend growth rate of just 5%. So I have the company forecasted free cash flow incorporating Wall Street analyst estimates for the first few years and then incorporating my own estimates between 2029 and 2035 and beyond. So I wanted to share that with you so you can decide for yourself if the numbers I'm using are accurate or too high or too low. Now, these free cash flows I have forecasted all the way out are expected in the future, but we want to know what the company is worth today. And to do that, we need to bring all of these cash flows back to today. You might say, well, how can you bring money back to today? Do you have a time machine or something? Well, sort of. We have a concept in finance that's called the time value of money concept. And I teach this in every finance course that I teach at university, whether it's an introductory course or whether I'm teaching graduate students. I have to teach the time value of money concept because it's so critical. And here's what it does. It takes money that you expect in the future, for instance, this $18 billion in 2027, and it gives you a value of what this 2027 cash flow is worth today. And when we incorporate the discount rate, which I'll share with you in just a little bit, it shows me that this $18 billion is worth 14.3 billion to me today. And the reason for that is money in the future is worth less to you than money today, right? We would all rather have money in our pocket today instead of money owed to us 5 years from now or 3 years from now. But at some price, we would be willing to say, okay, you know what? I'll take that money in the future instead of today. And the same is true when you're discounting it back to today. This means that I would be indifferent between $14.3 billion in free cash flow today or $18.02 billion in free cash flow in 2027. These two would be equal in my eyes as an investor. That's what the time value of money does. And the discount rate I'm using for Pfizer is 7.93%. And this is incorporating the weighted average cost of capital of 7.93% with a cost of debt of 7.5%. So the company has $66 billion in debt and a market cap of $150 billion. So the capital structure, the target capital structure I have at 40/60. Okay, so when we get the present value of all of those cash flows expected in the future, that comes to $805 billion for Pfizer. Now, to that total, we need to add the company's cash and subtract the debt of 66.6 billion, and that gives us a value of equity of 740 billion. And then we divide that by the number of shares outstanding so we can get the price per share. And when I do all of that calculation, I come to the conclusion that Pfizer's share price, the intrinsic value, is $129 per share. The current market price is $26.53. Now, whenever my calculations show me a big difference like this, where the price is so much higher or lower than the current market price, I do several other scenarios so that I can look at what the value would be under those different conditions, because maybe I used the number that was too high or maybe I used the number that was too low and it's showing me this big difference. So what I did is I took this beta of 0.62 and I analyzed the stock at higher betas. What if the beta was at 0.75 instead of 0.62? well, then the intrinsic value would be $109. If the beta was at 1.25, then the value would be $64 per share. And at a beta of 1, the value would be $82 per share. So even in these three other scenarios where I incorporate a higher beta, which means a more risky stock, I incorporate that. I say, well, maybe the stock is more risky than I'm estimating to begin with. And so I elevate the risk by increasing the beta. And even in those three scenarios, it shows me that Pfizer stock is indeed an undervalued stock. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.